Chair recognizes the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Chairman Powell, let me ask you a quick monetary policy question and then turn to bank regulation and Treasury market structure. I know hindsight is 20/20, but it's important to learn from mistakes, as you know, and you've conceded that the Fed miscalculated on inflation and mischaracterized inflation as transitory in 2021-2022 time period. Given that inflation remains stuck above the Fed's 2% target, will you commit to scrapping the flexible average inflation targeting framework? And if not, why wouldn't you commit to returning just to a simple 2% target?
So we're just beginning the review. It'll be done, as I mentioned, by the end of the summer, and that's the exact question we'll be asking. I can't commit to a particular outcome. I need to respect the process and the views of the other 18 participants on the FOMC.
Yeah, I appreciate that, and I just hope that in that process that you and your colleagues recognize that that framework allowed rising inflation to persist and allowed the Fed to mislabel it as transitory. Let me turn to bank regulation. In October of last year, I led a bipartisan CODEL to Basel, Switzerland, met with the Basel Committee on Bank Supervision, and there the committee actually conceded to us, agreed with me, that the Michael Barr proposal of July 2023 actually gold-plated bank capital requirements, and instead of actually promoting international harmonization, actually made American banks less competitive. They conceded that to us. So I applaud the Fed for not moving forward on that July 2023 proposal that would have made it harder for large banks to, among other things, facilitate the smooth functioning of the U.S. Treasury market, including holding treasuries on the balance sheet. Couple questions. One is, should the goal of our bank capital rules, should it be regulatory harmonization internationally, or should it be American economic competitiveness?
I mean, clearly, the goal is to have a strong banking system that supports American economic activity and growth. That's the ultimate goal. What you get from Basel is a global floor so that the other banks can't run on less capital and sort of have a short-term advantage. That was the whole point of Basel, was to get everybody to the same kind of level so that it wouldn't be the race to the bottom.
And I see that utility, but I think the goal of our regulatory system should be America first, and it should be about American economic growth and competitiveness. But let's talk about the Treasury market issues. Obviously, we're issuing a ton of debt right now. In fact, according to BlackRock, we're issuing $573 billion of Treasury bonds every week. To put that in perspective, the entire national debt of Australia is $573 billion. So we're issuing Australia every week in this country, if you want to think of it that way. Would reducing excessive capital and liquidity requirements on U.S. banks for intermediating U.S. Treasury market take the heat off of U.S. capital markets and increase Treasury market liquidity and stability?
I strongly think it would help.
Well, I think that's especially an important comment in terms of your regulatory approach, because, as you know, maturing bonds were being financed at an average of near zero during COVID, and now they're about double the cost of the average of about 3.5%. So now is not the time to make it more difficult for banks to hold treasuries. Let me just drill down with a little bit more detail on this Treasury market structure issue. Do you agree that the supplementary leverage ratio and the enhanced supplemental leverage ratio, the ESLR, are problematic as they create a disincentive for banks, especially large banks, broker-dealer affiliates, to serve as intermediators in the primary, secondary, and repo markets for U.S. Treasury securities?
I do.
And so you would commit to reviewing the SLR framework to create greater capacity for our banks to provide liquidity in the Treasury market?
I think it's time to move on the ESLR. And, we proposed doing so several years ago. We just didn't follow through on it. So I do think it's time.
Well, thank you for that. And finally, yesterday, during your appearance in front of the Senate Banking Committee, Senator Warren asked you about the future of consumer protection laws if the CFPB is abolished. Isn't it true, Chairman Powell, that prior to Dodd-Frank, consumer protection laws were implemented by financial institutions' primary prudential regulators?
Yes.
And so if there were a decision by the Congress and DOGE or whatever to repeal the CFPB, we could return the consumer protection law enforcement function to other financial regulators.
You could, yes.
Thank you. I yield back.
Gentleman yields back. The chair now recognizes